Chapter 4. The Boom and First Major Crashes, 2013-2015. By 2013, Bitcoin had grown from an obscure experiment into a financial phenomenon. Its early adopters were no longer just hobbyists. They were believers, speculators, and opportunists. The first halving in 2012 had already taught the world about Bitcoin's scarcity, and now its effects were beginning to ripple through global markets. Bitcoin was poised for a boom, and with boom comes the inevitability of bust. The first major surge. The year 2013 began quietly, with Bitcoin trading at around $13–15. Yet as media coverage grew, interest from investors increased. Exchanges became more accessible, wallets more user-friendly, and a new generation of entrepreneurs began to see opportunity. By March 2013, Bitcoin had climbed to $50, then $120 by April. Headlines declared a Bitcoin frenzy, and skepticism mingled with fascination. For the first time, outsiders began asking, is this the future of money? Mt. Gox and the fragility of infrastructure. At the center of Bitcoin's early trading infrastructure was Mt. Gox, an exchange based in Tokyo. Once handling 70% of all Bitcoin transactions worldwide, it was the de facto gateway for fiat to Bitcoin trading. Mt. Gox's success masked serious vulnerabilities. The exchange's security was poor, its internal systems opaque, and its leadership inexperienced. Yet for many early traders, it was the only place to buy Bitcoin with US dollars or euros. By late 2013, Bitcoin's price had surged to over $100, fueled by speculation, media coverage, and growing awareness of its scarcity. Early miners and investors saw unprecedented gains, while newcomers rushed in, driven by fear of missing out. Volatility and the first crash. As the price peaked, cracks began to show. Exchanges struggled to handle trading volumes. Rumors of hacks and lost funds spread. Fear and uncertainty gripped the market. By December 2013, Bitcoin's price had fallen from $2,100 to under $600, a 45% drop in a matter of weeks. The crash reminded the world that Bitcoin was volatile. Its scarcity and fixed supply made it valuable, but its lack of regulation, its dependence on fragile infrastructure, and its small market capitalization made it fragile. For believers, the crash was a test of conviction. For skeptics, it confirmed Bitcoin as a speculative bubble. Media frenzy and public perception. The boom and crash brought Bitcoin into the mainstream consciousness. Newspapers, TV shows, and online outlets debated its legitimacy. Was it a revolutionary currency or a Ponzi scheme? Governments began to take notice. Regulators in the US, China, and Europe issued warnings. Yet this attention also lent credibility. Bitcoin was no longer a niche experiment. It had entered the public consciousness as a real financial asset. Silk Road and legal challenges. Bitcoin's association with the Silk Road black market intensified scrutiny. While many early adopters celebrated its ability to enable free trade outside government control, authorities saw criminality. In October 2013, the FBI seized Silk Road and arrested its founder, Ross Ulbricht, aka Dread Pirate Roberts. This event demonstrated that while Bitcoin was decentralized, its use could bring legal consequences. Yet the market shrugged. Despite the seizure, Bitcoin's price stabilized and eventually recovered. The first lesson was clear. Bitcoin's network is resilient, even if its users face legal challenges. The 2014 Mt. Gox collapse. The real shock came in February 2014 when Mt. Gox filed for bankruptcy, claiming it had lost 850,000 BTC, worth hundreds of millions at the time, due to hacks and mismanagement. The collapse devastated the market. Bitcoin's price fell from over $800 to $400, and public trust in exchanges plummeted. Investors learned a painful lesson. Digital scarcity alone cannot protect against human error, fraud, or poor infrastructure. Yet the crash also strengthened the community. Developers, miners, and traders began prioritizing security, decentralization, and transparency. New exchanges with better practices emerged, laying the groundwork for the next wave of growth. Bitcoin's resilience. Despite the crashes, Bitcoin endured. Its protocol remained intact. The halving schedule continued. Scarcity remained immutable. Miners adapted, traders recalibrated, and believers doubled down. By 2015, Bitcoin had stabilized in the $200–300 range, smaller than its previous highs, but stronger in community, infrastructure, and global awareness. It had survived the first major test of hype, speculation, and infrastructure failure. Lessons learned. The first major boom and crashes taught the world several key lessons. Volatility is inherent. Bitcoin's small market and fixed supply create large swings. Infrastructure matters. Exchanges and wallets must be secure, reliable, and transparent. Scarcity is powerful. Each halving and supply cap creates long-term value potential. Decentralization is resilient. The protocol survived even when central hubs collapsed. Belief drives value. Bitcoin's price depends not just on code, but on trust, speculation, and adoption. These lessons set the stage for the next chapter in cryptocurrency history. The emergence of altcoins, the rise of Ethereum, and the first wave of ICOs that would reshape the crypto landscape forever.